Let's jump right into the fascinating world of trading with Frank Miller's Simplified Price Action. This book is an excellent starting point for anyone curious about price action trading. Miller cuts through the clutter of complex financial indicators, focusing instead on the price itself to explain how to trade effectively in simple, straightforward language. Why is this book so significant? Well, price action offers investors a real-time pulse of the market. By focusing on the price rather than indicators, traders gain clearer and more direct information. For instance, when a stock's price rises, it generally signals increased buying demand, which helps investors make more informed decisions. The book also highlights the unpredictable nature of markets. With countless strategies and mindsets in the forex market, achieving definitive results is nearly impossible. In this uncertainty, managing losses and maintaining psychological resilience are crucial. Miller emphasizes that being a successful trader starts with managing losses and protecting capital. In essence, Simplified Price Action is a valuable guide for anyone looking to succeed in the trading world. If you're keen on enhancing your knowledge and refining your trading strategies, this book is a must-read. Be patient, adapt to market dynamics, and stay true to your trading rules. Remember, a consistent mindset and disciplined approach are essential for sustained success. Thanks for tuning in, and see you in the next episode. Frank Miller is a prominent figure in the financial world, known for his focus on price action trading. His book, Simplified Price Action, serves as a guide for investors to better understand market movements. Miller's primary goal in writing this book was to move away from complex financial indicators and present a simpler, more understandable trading strategy by focusing on the price itself. Published in 2015, the book quickly gained popularity among both beginners and experienced investors. Miller's motivation for writing this work was to provide investors with a clearer perspective against the unpredictable nature of markets. Price action trading involves tracking changes in an asset's price and making trading decisions based on this data. This approach allows investors to obtain instant and direct information from the market. For example, a rising stock price indicates increased buying demand, which helps investors make strategic decisions. In his book, Miller particularly emphasizes the importance of discipline and psychological resilience. The forex market is known for its uncertainties, and dealing with losses in this environment is one of the most crucial traits of a successful trader. Miller explains that adopting the right mindset and adapting to market dynamics are critically important for consistent success. Historically, Simplified Price Action is considered one of the pioneers of the simplification trend in the finance sector. By introducing price action trading to a broader audience, the book has led many investors to reevaluate their strategies in this area. Miller argues that investors should remain disciplined while managing their losses and that patience will lead to long-term gains. This is one of the core messages of the book that remains relevant today. In short, Frank Miller's work stands out as a valuable resource that helps investors simplify the complex appearance of markets. In today's podcast episode, we'll dive into the main ideas and key concepts from Frank Miller's Simplified Price Action. We'll discuss how focusing on price action rather than indicators can be effective in market analysis and what we can do in terms of risk management and strategy development. Let's get started. First off, what is price action and why is it so important? Price action involves making trading decisions by tracking the price changes of an asset over time. In other words, we focus on the price itself rather than indicators. For example, if a stock's price is rising, it indicates increased buying demand. This kind of approach provides investors with clearer and real-time information. By focusing on price action, you can keep your finger on the market's pulse and make more informed decisions. Another important topic is the unpredictability of market dynamics. Especially in the forex market, which is filled with thousands of participants with different thoughts and strategies, achieving definite results is nearly impossible. In this environment of uncertainty, dealing with losses and maintaining psychological resilience is vital. Successful traders learn to stay disciplined while managing their losses. This enhances the investor's mental resilience and leads to success in the long run. The book also emphasizes the necessity of focusing on a consistent trading strategy. Forex trading often results in losses, and investors frequently try to compensate for these losses by changing strategies. However, Miller underscores the importance of developing a consistent strategy and sticking to it. Protecting capital and managing losses are the cornerstones of being a successful investor. Investors should not forget to protect their capital while chasing gains. It's also worth mentioning the advantages of trading in higher time frames. Weekly and daily charts help us better understand the overall trends of the market. Trades made in shorter time frames can be misleading, hence, evaluating the market from a broader perspective can minimize losses. For example, a downtrend on daily charts can overshadow sudden upswings on hourly charts. Determining a risk-reward ratio is also a critical factor for success. For instance, trading with a 1-to-3 ratio offers the potential to earn $3 for every $1 lost. This kind of approach makes the investor more resilient against losses and reduces psychological pressure. It's important to remember that Forex is a game of probability, and a patient approach will always pay off. When we look at market dynamics, it's possible to see the struggle between buyers and sellers. This battle between bulls and bears forms the foundation of trading strategies. If bears are strong, the market shows a downward trend. However, when bears get tired and bulls gain strength, it can create a buying opportunity. For example, when the price of a currency pair falls to a certain support level, it can bounce back from there, creating a buying opportunity. Support and resistance levels play a critical role in market analysis. These levels, determined in higher time frames, help us understand the general trends in the market. Support levels act as points where prices have previously turned around. Prices approaching these levels usually catch the attention of traders. For instance, when the euro to US dollar pair reaches the 1.2000 level, it would be beneficial to observe the market's reaction, considering this level as a significant peak in the past. Patience is perhaps the most important part of trading. Waiting to trade at specific levels helps us avoid unnecessary losses. Filtering and analyzing the right signals is key to creating a successful trading strategy. Another important topic emphasized in Frank Miller's book is understanding the change in market structure. The inability of prices to surpass certain resistance and support points plays a critical role in determining the market's direction. For example, if a resistance level is not broken twice, it shows the strength of that level. In such situations, it is recommended for investors to be cautious and avoid trading. Engulfing candle formations are also important analysis tools. If these formations occur at support or resistance levels, they provide reliable signals. However, the importance of the level where the formation occurs should not be overlooked. Investors should not immediately think of trading when they see an engulfing formation but should first check whether the market structure has changed. There are also specific criteria for understanding the transition from a downtrend to an uptrend. At least 2 higher lows and 1 higher high level should form. These criteria help investors minimize their risks and require careful monitoring of market movements. When conducting market analysis, it's important for price movements to provide reliable signals. Especially in the transition from a downtrend to an uptrend, certain criteria must be met. For example, the market should not form a lower low and should surpass the highest level of the previous downtrend. 2 higher low levels should form, and these levels should not be lower than the last high level of the previous trend. For example, when an investor sees a 2-day bearish engulfing formation in the US dollar to Canadian dollar pair, they should combine it with a trend line to get a reliable signal. If the formation does not meet sufficient criteria, it's best not to enter trades. Instead of acting hastily, waiting for the market structure to become clear can be more profitable. Double top and bottom formations are also important concepts. Certain conditions must be met for these formations to work reliably. For example, if a double top forms at a strong resistance level, it can signal a market reversal. However, for the formation to be confirmed, the price must break the neckline. To illustrate with a real-life example, when a stock in an uptrend reaches a certain resistance level and forms a double top there, investors might consider selling as the pattern breaks. However, the key point to note is to enter at the Z level instead of trading at the T2 level. Because Z is a safer entry point and can increase your risk-reward ratio. In conclusion, to succeed in the Forex market, focusing on price action, developing the right strategies, and being patient are crucial. The valuable concepts in Frank Miller's book can guide market analysis and trading strategies. Remember, the market is always full of uncertainties, and adopting a disciplined and patient approach is essential to dealing with these uncertainties. See you in the next episode. Goodbye. Here are 5 key lessons from this book that you can apply to your life. 1. Focus on price action. In Simplified Price Action, Frank Miller emphasizes the importance of focusing directly on price action rather than indicators when trading. He points out that by concentrating on the price itself, investors can gain clearer and real-time information. For instance, when an asset's price rises, it indicates increased buying demand, and this information helps investors make more informed decisions. This approach allows investors to better understand market dynamics and provides a clearer perspective in decision-making processes. 2. Coping with market uncertainty. Miller highlights the unpredictability of the Forex market due to the different thoughts and strategies of market participants. In this environment of uncertainty, being able to cope with losses and maintain psychological resilience is critically important. Successful traders learn to stay disciplined while managing their losses. For this, investors need to control their emotions and stick to their trading strategies. Discipline and emotional balance are essential for continuity and success in trading. 3. Consistent trading strategy. In an environment where changing strategies in Forex trading is tempting, Miller emphasizes the importance of sticking to a consistent trading strategy. Managing losses and protecting capital should be the primary goals for investors. He notes that investors should not forget to protect their money while chasing gains. This helps investors achieve sustainable success in the long run and increases the effectiveness of their trading strategies. 4. Importance of time frames. The advantages of trading in higher time frames are frequently mentioned in Miller's book. Weekly and daily charts provide important insights for better understanding the market. Trades made in shorter time frames can often be misleading, so evaluating the market from a broader perspective can help investors minimize their losses. For investors, analysis made in longer time frames contributes to making more reliable and solid trading decisions. 5. Determining risk-reward ratio. A good risk-reward ratio is a critical factor for long-term success. Miller states that trading with a 1-to-3 ratio offers the potential to earn $3 for every $1 lost. This approach makes investors more resilient against losses and reduces psychological pressure. Investors should consider this ratio when managing their risks and carefully evaluate their potential gains and losses before trading. It's important to remember that Forex is a game of probability, and a patient approach always pays off. The lessons we've learned from Frank Miller's Simplified Price Action offer important guides for anyone looking to succeed in the trading world. Applying these principles can provide significant advantages in your trading career. If you enjoyed this book, you might also want to check out these. First, Al Brooks' Price Action Trading offers an in-depth understanding of price action trading. Brooks explains how to trade in different market conditions with detailed chart analyses and helps you develop real-time decision-making skills. Second, Steve Nison's Japanese Candlestick Charting Techniques is a classic on candlestick charts. Nison explains how to interpret Japanese candlesticks in detail, starting from their history. This book helps you better understand chart formations and take better positions in the market. Lastly, I recommend Mark Douglas's Trading in the Zone. Douglas emphasizes the importance of trading psychology and explains how controlling your emotions can enable you to make more successful trades. This book is quite helpful for understanding that trading is not just about technical analysis and for strengthening your psychological resilience. These 3 books will strengthen your knowledge of price action trading and bring a new perspective to your trading career. We've reached the end of our journey with Frank Miller's Simplified Price Action. This book approaches the seemingly complex world of price action trading in a simple and understandable way. By focusing on price action, we've seen how investors can keep a real-time pulse on the market. Focusing on the price itself rather than indicators offers investors a clear and straightforward perspective. While the book underscores the unpredictability of the market, it emphasizes the importance of dealing with losses and psychological resilience. Successful traders manage their losses in a disciplined manner and prioritize protecting their capital. Additionally, evaluating the market from a broader perspective and patiently waiting for opportunities is critical for long-term success. In conclusion, the most important lesson we've learned from Frank Miller's work is that being patient and sticking to trading rules will lead to long-term gains. Don't forget to subscribe to the Book Bank channel. See you in the next episode. Goodbye. If you enjoyed this video, don't forget to subscribe to the Book Vault.